All right. Don't get caught with your pants down. The top questions homebuyers ask regarding money and financing when they begin looking for a house. I'm Katie McDaniel with Keller Williams Realty. I service the greater Louisville area, and I'm here today with.
I'm Annie James with Evo Mortgage, and we can do loans in Kentucky, Indiana, Ohio, and Florida.
Awesome. So the number one question I get, I'm sure you get the same one, is how much can I afford?
Well, Katie, that's actually going to depend on a lot of factors. It's going to depend on your purchase price. It's going to depend on your gross income that you've got coming in every month. It's going to depend on the debts that you have on your credit report. What kind of savings and do you have saved up? Like, what kind of assets do you have? What is your employment history? Do you have a full 2-year full-time employment history without any job gaps? What's your rental payment history? Have you been late on any of your rent payments in the past 12 months? Have you got payment plans, or have you paid off any non-medical collections that are showing up on that credit report? That's a big one too. And if you've got those medical collections on there, we're just going to leave them alone for right now, because a lot of times that does not affect your loan.
Nice. All right. So what about next one, credit score?
Ooh, that's a big one. So there are 4 major loan types and hundreds of loan programs within those loan types. So let's break those down. So the first one, which is the most common type of loan and the loan that most people are going to qualify for, is an FHA loan. Your credit score for an FHA loan, if you are bringing your own 3.5% down payment to the table or more than that, you're going to need a credit score of 600 or above. If you are applying for down payment assistance on one of those FHA loans, your minimum required credit score is going to be 620 on that. The next loan type is conventional. So if you're going to be a conventional borrower, those borrowers need at least a 690 or higher. So not everybody's going to qualify for a conventional loan, and that's okay. The next one is a VA loan, and on VA loans we can typically go down to about 600 for those credit scores. And USDA loans, those are our rural housing loans, those require a 620 or above credit score.
Very cool. So you talked about the different types of loans. Can you talk about that in detail a little bit more? What's the difference between them?
Sure. So FHA loans are the most common types of loans. That's probably the most prominent loan program that I get my borrowers pre-approved for. They are really forgiving on debts like student loans. They have a higher threshold for your debt to income ratio. They don't have as strict of credit score requirements like a conventional has. So you can have an FHA loan whether you're a first-time home buyer or you're buying your second, third, fourth home. The advantage of those FHA loans are they have typically a little bit lower credit or lower interest rate. So borrowers love that. That's a big advantage to those FHA loans. The next type is conventional, and those have a little bit higher interest rate than those FHA, but those loans are great for people who have maybe a higher purchase price that they're wanting to buy, and you know that there's going to be multiple offers on a home. You basically want a strong borrower who's going to be able to beat out those other contracts. So those conventional mortgages, they require a lot more. They require a higher credit score. They require a lower debt to income ratio. They require more assets. So like you'll need to have a little more in your savings account than you would if you were just going with the typical traditional FHA loan. With VA, those are wonderful loans for anyone who has military service. Whether you're active duty or whether you're a veteran and you qualify for those VA loans, they are wonderful. They don't have mortgage insurance. So you can do a VA loan and put no money down if you'd like. There is a funding fee that's typically associated with those VA loans, and it's about 3 to 3.5% of your purchase price. But if you decide to put money down on that VA loan, then it will drop your funding fee down to 1.5%.
That's awesome.
So that is an advantage. VA loans typically have the lowest interest rate of all the loan programs offered out there. So there are lots of advantages to getting a VA loan. And the last is USDA, and that's rural loans. So that is going to be property specific. So like Jefferson County, they don't qualify for that because it's not a rural area. It's more, metro. So your counties like Bullitt County, where I live, LaRue County, Hardin County, those counties that are more rural are going to have properties that qualify for those USDA loans, and they don't require a down payment on those loans. So you do have to bring your closing costs to the table on those USDA loans typically. But with those USDA loans, that 100% financing is available. And they typically have similar interest rates to FHA loans. So a little bit lower than the conventional. And they do have mortgage insurance on those USDA loans. It's a fixed amount on those. Lots of properties in Indiana are also going to qualify for those USDA loans. So they're great. The one thing that we have to remember on USDA loans is it's income based and it's household income based. So if you make a salary that's a very high salary, a high paying job, you're not going to be USDA candidate. But we can talk more about that on a one-on-one basis.
All right. So down payment, a lot of people think you have to bring 20% down. Is that true?
That's not true. So on FHA loans, the minimum down payment is 3.5% on that. On conventional loans, if you are a first-time home buyer, you can bring 3.5% down payment on those conventional loans. If you are not a first-time home buyer on a conventional loan, then your minimum down payment is going to be 5%. As far as the mortgage insurance on a conventional loan, the more you put down, the less mortgage insurance you're going to have to pay. And you'll often hear lenders refer to that as PMI. So if you put down 20% on a conventional loan, you have no mortgage insurance at all. So that saves you quite a bit right there. There's no mortgage insurance on a VA loan as well. And then the USDA, those down payments, I told you those are 100% financeable, and they have a little bit of mortgage insurance on those.
Does the mortgage insurance on an FHA drop off also at the 20% mark?
Typically, no. No. You're going to have FHA mortgage insurance and USDA mortgage insurance for the life of the loan. At a conventional loan, the mortgage insurance is going to drop out once you achieve 20% equity in the home. So it's kind of like you put 20% down payment, you don't have the mortgage insurance.
Mm-hmm. Would you let that stop you from using one of those loans?
Absolutely not. Sometimes in a situation, Katie, you can qualify for multiple loan types. So you may say, hey, Annie, I want to see the difference in my payment for an FHA loan versus a conventional. And I can show you those numbers. And then when you and Katie are writing that contract, the two of you can decide which offer that you want to make for that listing agent. And you can decide if you want to go FHA or if you want to go conventional.
So how many people actually keep their loan for the full 30 years?
Very slim. People typically refinance for lots of different reasons. And a lot of people say, oh, I don't want to refinance my 4% interest loan. And I certainly understand that, but you have to look at the numbers. So let's say you bought a $500,000 house, but now you only owe $200,000 on it. So do you want to pay interest on a $500,000 mortgage, or do you want to pay interest on a $200,000 mortgage? So that's why I said it's not always about the rate. if you could refinance, even if it's a little higher rate, let's look at the total balance we're refinancing, and it makes more sense. You would have a lower monthly payment, and you're only paying interest on a smaller amount. So very rarely do people keep that initial loan for the full 30 years. Sometimes they refinance just to pay off things like credit card debt, or if they've got like a really high boat or car payment, they're wanting to just get rid of that debt. You can refinance, get a little bit extra out, and pay off those debts.
All right, so we kind of have an idea of what it takes to figure out what you can afford, what your credit score needs to be, and the different loan types and options that are out there for you. What are some of the additional costs that come with financing a
Sure.
house?
So you're going to hear a lot of talk about closing costs. What are closing costs? So closing costs are going to include things like your property taxes. And at the closing table, we're going to collect a little cushion for those property taxes, because who knows if they're going to go up or not, you know? We're also going to collect for a year's worth of your homeowner's insurance at the closing table. That's, again, going to ensure that investor on the loan, you know, on that property when we collect that and prepay that. So that's part of your closing costs. The title attorney, who does all that hard work on your loan, researching the title, the liens, and things like that, they have to get compensated. So those closing costs are going to include those title fees. And your earnest money is an additional cost, but it's not necessarily a closing cost. It's going to come off of what's owed at the closing table. So if you put down $1,000 earnest money deposit, that comes off the total needed at the closing table. And then your inspections are also an additional cost. They are not required on your home loan, but we're definitely going to recommend that you get a home inspection, and Katie can talk to you more about that at length and why that's important and how that protects you as a buyer. And then the other additional cost we're going to have is going to be our appraisal. Those are typically around $600. They can be more if it's a more complex property, or like an investment property or something like that, or maybe it's a property that has 2 or more units. So your appraisal cost will need to be paid for by you when we order that. So all of that kind of wraps up into...
Should you get pre-approved?
Yes, absolutely.
100%.
And the reason is you're going to be talking with your partner like, hey, I think that we need to buy our home this spring. And you're bringing up all these ideas, and you're thinking about what location you want to buy the home in, and is this going to be close to my work? Is this going to be in a neighborhood that I feel safe in? Things like that. And you're going to go somewhere on a Saturday afternoon and drive by that perfect neighborhood, and there's a home that's just listed for sale, and you call Katie and you say, hey, I want to make an offer on this house, and she's going to say,
are you pre-approved?
And if you're not, she can't write that offer for you, because she has to submit that pre-approval letter from your lender to the listing agent when she sends your offer. So you don't want to be caught with your pants down. You want to make sure you're pre-approved so that you can make that offer
when the right property shows up, because
Yes.
it may not be where you expect.
And you want to do that quickly.
And sometimes when your credit's pulled, there are some things that show up there you may not even have knowledge of. So having the time to get those things corrected before the right things in place, and that we know the right number, so that when we do start shopping for houses, we're shopping in the right price point and not falling in love with houses that you can't afford. And now nothing is going to fit in your price point because you're dreaming of the house you can't afford. Right. So yes, in a warm market, though, here's the other part of a pre-approval. Pre-approval is a wonderful tool, and when we have a seller, they definitely want to see that make sure that the buyer can perform and has the funds to be able to do that. But sometimes when the market's getting pretty hot, which we tend to see in the spring or different other scenarios, and you're competing against other offers, there's actually a way to sweeten your pre-approval to make it almost good as cash. How do they do that?
So you can get your loan fully underwritten before you even get under contract. So I know a lot of lenders don't offer that, but Evo Mortgage offers that. You can get fully underwritten before you get under contract, and it's just gonna make your loan process go really, really quick, and you can typically close faster. And it shows that seller that you're really prepared and you're really on your A game, ready to purchase and ready to jump.
And no financial surprises should come up along the way, right? Like
Right.
appraisal's still going to happen, but like everything else has been checked and double checked. So when I, as having a buyer that's underwritten, I'm going to call and let them know, and it's going to be in when I send the offer over. Don't forget, we are underwritten, so we really are just waiting on the appraisal. And then I'm also going to have Annie shout out and be like, hey, they are underwritten. Like, this is as good as cash. Like, like, don't forget that as you are looking at things. So if you're feeling like after this ready, you're like, yeah, sure, I want to know what I can afford. Like, let's talk about my credit to see if I need some help and assistance. Like, we're here to meet you where you are. So even if your credit score isn't a 600, maybe Annie could.
We'll get you pre-approved. So let's see what we can do.
Yep, check some things out. And if you need some help, we can definitely get you connected with a credit repair person. And if you just have more questions in general about the loan types or the cost and how that particularly applies to you, then numbers are going to be up there. Call or text Annie and I, and we'd love to help you out on the next step. Talk to you all soon.